Chapter 19. This is Part 1, and we're going to look at restricted stock plans, restricted stock awards, and restricted stock units. Now, shared-based compensation are forms of payment whose value is tied to the market price of the company's stock. Share-based compensation plans include stock award plans, stock option plans, stock appreciation rights, or SARs, are one of the several similar plans. The goal are to provide compensation to designated employees while sometimes providing those employees with a performance initiative. Our objective in accounting is to determine the fair value of the compensation, to expense that compensation over the periods in which the participants perform the services. Now, restricted stock plans. These plans are usually tied to continued employment. The two primary types of restricted stock plans are the restricted stock awards, where people get stock in their name, and then the restricted stock units, which say you're entitled to get stock. So, restricted stock plans. Physical possession might be retained by the company, awarded in the name of the employee, subject to forfeiture by the employee if the employment is terminated within some specified number of years from the date of the grant. Not free to sell the shares during the restriction period, but receive all the benefits of stock ownership. Now, restricted stock awards. Once the shares vest and the restrictions are lifted, paid-in capital is affected. We are going to reduce restricted stock and replace it with common stock and paid-in capital at excess of par. Any market price changes that might occur after that don't affect the total compensation. The only stock market price fair value you need is at the date of when they start the vesting. So let's take a look at an example, and this is a stock award. Now, my corporation offers a restricted stock award plan to its vice presidents. On January 1st, 2020, the company grants 10 million of its $1 par common shares with a $7 face value on the grant date, subject to termination if their employment is terminated within 2 years. What are the journals? First, we determine the total compensation. It's going to be 10,000 shares times $7, which is the value on the grant date. And then we're going to allocate it over the service period, which is 2 years. And that's 35,000. Now, we're going to allocate the cost over the service life. Now, when it's initiated, there's no entry because this is something that accrues over time. We're going to do, at the end of the first year, though, we're going to do compensation expense, paid-in capital, restricted stock. At the end of the second year, we're going to do the same thing. And in addition, we're going to take it out of paid-in capital, restricted stock, and then we're going to do common stock and paid-in capital in excess of par. And remember, common stock is always going to be number of shares times the par value. Now, restricted stock units. It is a right to receive a specified number of shares of company stock. The company distributes the shares after the recipient of the RSUs satisfies the vesting requirement. The recipient benefits by the value of the shares at the end of the vesting period. Now, restricted stock unit costs. Share-based compensation cost for RSUs is measured based on the closing fair market value of the company's common stock on the date of the grant. The company recognizes share-based compensation cost over the award's requisite service period on a straight line basis. Now we're going to look at an example. Now, on January 1st, my corporation grants RSUs of 30 million or 30 million shares, since it's $1 par, to executives subject to forfeiture if terminated within 3 years. The common shares had a fair value on the date of the grant of $12, and it is estimated that 6% will leave prior to the vesting. On January 1st of 2021, 61% of the RSUs are forfeited due to turnover. The stock's fair value on December 31st, 2022 is $25. Now, first, we need to understand the rule. There are two approaches that can be used if forfeitures are due to turnover, and we can estimate them. The preferred method is to estimate forfeitures at the grant date, but a company can also record forfeitures as they occur. So we're first going to use the estimated method. So what that means is we have to reduce what we book by 6% in this case. So we're going to take $12 times 30 million RSUs, and then we're going to take that times 94%, which tells us the estimated total compensation. We're going to allocate it over the vesting period, so we're going to take that and divide by 3. And our journals, we're going to have no entry when they start, but at the end of the first year and at the end of each year, we're going to do the same journal entry. Now, what happens if instead we decide to just go ahead with the forfeitures when they occur? Because we're thinking, maybe they won't forfeit. Maybe they'll stay the whole time. So, in this case, the expense is the whole $360 million. We're going to divide that by 3. And we're going to, no journal again when it starts, but at the end of the first year. But now this is when it gets a little complicated because we had forfeitures in the second year and we have to adjust for that. So on December 31st, we're going to have to adjust for the 6% forfeiture, but that adjustment is also going to have to adjust what we've already booked. So we're going to take our estimated expense and we're going to subtract out that 6%, and that tells us our estimate is only actually $338,400,000. We're then going to divide that by 3, which tells us the yearly allocation should be $112,800. And we're going to take that times 2 because 2 years have gone by. So what we're saying is it should be 2021. Let me fix that right now. Now I fixed it and put the year correctly as 2021. So through 2021, we should have booked $225,600,000 less what we booked in the prior year of $120 million, which tells us we need to only allocate $105,600 to get us back to where we should be based on a 6% forfeiture. So our compensation expense for the end of 2021 is going to be $105,600. Now, what about the next year? The next year, we're going to use the $112,800 because that's the amount that should be allocated yearly. And if we were to add those 3 numbers up, we would get $338,400,000. Now, what happens when at the end of the 3-year period and we lift the restriction and the fair value is $25, and this is the journal entry regardless of the method we used? We would take it out of paid-in capital. We would then take it to common stock. We would have 28,200,000 shares. And the difference would go to additional paid-in capital. And the calculation you see down there is you're going to take 30 million times 6%, and that's 1.8 million, and subtract that from the 30 million, and that's how you get the 338,400. And that ends part 1.